So yesterday, the Reserve Bank made its move and they decided to increase the cash rate, which is the rate that all the lenders borrow their money out. It's called the overnight rate. And so that was increased by 25 basis points. Now, that's what the layman or the rest of us call 0.25%. It took our cash rate from 3.6 to 3.85%. As I said, that's the rate that the lenders are borrowing in their overnight rate to get the money. That is definitely not the rate that you and I pay to our lender. And that's because they put in an extra amount. So that's how they make money. If they were only charging us the same rate that they're paying, well, they don't make money. And of course, as we know, banks are not a charity. They are a business and they need to make money. So I decided to push back the podcast that we had scheduled for today. As we said last week, that our new podcasts are going to be question and answer styles that we have come in from our listeners or our community. Adriana and I had a podcast ready that would go out today, but I decided to push it back after yesterday's rate rise because I had a lot of people contact us a little bit panicked about how they were going to afford what is about to announce from their lenders in the next couple of days. So you can rest assured that if you haven't heard from your lender today or in the next couple of days, you will get a rate rise. It may even be more than that, 25 basis points or 0.25%, because some of the lenders will take this opportunity to increase because sometimes they want to make a little extra profit. And so if they only put it up by 0.25%, they're not making any more money. And sometimes it's a little bit opportunistic that people are already upset, people are already cranky. So instead of putting it up 0.25%, we might put it up 0.35%. Now, that was the RBA's move yesterday, was to increase the pricing. What is really important is what is your next move? So let's talk about that for a moment. Let's just talk about potentially what your mortgage rate increase may be. So I've got some figures that I did some calculations on yesterday afternoon. So if your home loan is $500,000, you could be paying $80 a month extra. If your mortgage is $600,000, you will be paying about $100 a month. And if it's $750,000, you will be paying approximately $130 a month extra. Now, I guess the question that I get asked all the time is, why does the RBA put up the cash rate? And they do that because we'd like to have, as a government and the RBA, to have our inflation rate at somewhere between 2 and 3%. That keeps the economy ticking over without it going too high, that it pushes up the prices of goods and services, and they don't want it too low because that will devalue the price of goods and services and will send our economy free falling, basically. So our inflation rates after Christmas was higher than they had hoped. And, that can be because of Black Friday sales, it's the Christmas spending. There's lots of reasons that it can be up. But when that inflation rate came in at higher than expected, we knew this rate rise was coming. We knew that the government and the RBA want to slow our spending because reducing how much we spend is the quickest and easiest way to get our inflation under control. By increasing mortgage rates, and that increases our repayments, that reduces the amount of disposable income that we have and what we can spend. Therefore, it reduces how much money we're putting out into the economy, which will slow down the spending, bring inflation down. So that's the theory behind why they do that. If they want us to spend more to get the economy moving, they do the opposite and they will decrease the cash rate, which is what has been happening. But of course, we did it slow and steady. We heard lots of commentary about how come Australia did it so slow when other countries dropped the rates really quite quickly to get everything back under control. We did it in Australia at a slow and steady rate on the basis that they would hope that that would keep everything under control. We didn't have too many job losses. they don't want inflation going too high or dropping too quickly, because that impacts the unemployment rate really quite quickly. So if businesses aren't making money because they've had to put wages up because the cost of living's gone too high, well, obviously they put off people, or they don't spend, they don't do improvements, they don't do contracts and things like that. And that can then impact job security. People go on to social security. It's a vicious cycle. They don't get off it quite so quickly. So the government wants everything to stay quite steady so that any impact is minimal on the economy and our employment. So interest rates are going up now to slow our spending, which will hopefully bring down our inflation. The RBA have already flagged that this may not be the last increase for this year. I mean, we're only in February. It's another 2 months before the RBA will meet again. Remembering the RBA meet every second month on the first Tuesday of the month. So it's already been flagged that if they can't get this under control, they will continue to increase the cash rate. So the benchmark obviously influences variable home loans almost immediately. You will hear the lenders all announce this if they haven't announced it now. It will not affect fixed home loan lenders, and that's because that's the beauty of a fixed loan. If interest rates go up, your rate doesn't go up. If interest rate goes down, though, you also don't get yours to go down. So if you are a borrower and you are on a fixed rate, you can breathe a little sigh of relief now, although depending on how long it's fixed, or when you fixed it, of course, you may be on a higher interest rate than a variable one anyway. So there is no right or wrong way. The idea behind a fixed rate is that gives you certainty about how much your monthly repayment is. So we had a client last night that we were talking to that rang a little panicked. They're on a fixed rate home loan. Their loan balance is $600,000, it was just over $600,000. They're fixed at 6.2%. The variable rate we could get them, would be in the fives. All the mortgage rates up until yesterday, well, you should have had one that was in the fives. So their fixed rate's not going to change, and it's going to stay at that 6.2%. They come off their fixed rate in April. So it'll be interesting whether their repayments would have dropped anyway. But what we said to them is they need to look at refinancing, a couple of weeks out from their fixed rate coming off to see whether they are. We did a calculation yesterday just for them, and they would have saved by refinancing to a better rate something like $300 or $400 a month. I can't remember what the exact figure was now. So keep in mind, if you have a variable rate home loan, you don't need to sit on your hands. You need to be proactive. The banks will always look for us to be lazy. And I say that with love. Most people can't be bothered. They just go, what's the point? Every lender's going to put it up. Yes, every lender is going to put up the interest rate, but every lender may not be on the interest rate that you are on. So the first thing that you need to look at if you are on a variable rate, or even if you're going to come off a fixed rate very soon, is what is better out there in the market for me? And that's a really important question to ask yourself. What is my next steps? And when I talk to people, we always say to them, you can sit and you can procrastinate, you can sit and you can complain about things costing more. But if you're proactive and take steps to put things in place, to see if you can get something better, to look at your spending and all of those sorts of things, you will be better off. Now, the thing that I've just talked about is home loan people. I want you to understand that this rate rise that the RBA has put through is not only going to affect mortgage interest, it's going to affect all interest that's there. So if you have a personal loan, if you have credit card debt, if you have buy now, pay later debt, if you have payday debts or any of those awful debts, you are going to pay more. They take it, as I said, the lenders are all opportunistic. And whilst payday debts isn't tied to the RBA as such, they're going to charge you more if they can. Don't sit on your hands and do nothing. If you don't have a home loan, you may have a car loan. So look at everything to see where you can get a better deal. If you can do a couple of hours work of refinancing any loan and you can get into a better situation, it's going to change the way you pay things or how much you have to pay. You will always be better off. Procrastination and apathy is what lenders rely on so that they can make more money. I mean, we've all heard it, haven't we, that there is a better rate for new lenders than there is for existing customers. And that is the price you pay for not being proactive. So if you think that you're paying too much, we can help you with scripts to talk to your lender firstly to see if they'll give you a better rate. Or more importantly, reach out to us and I'll get Adriana, who's my mortgage broker, or one of my other mortgage brokers to have a chat to you to work out if we can get you a better loan. Because if you can save $50, $60 a month by refinancing, you would be crazy not to. So that's my first thing that I need you to do, is to look at your debt strategy, look at how you're going to pay off your debt, how you can get a better interest rate. Then what I want you to do is to look at your spending. Now, I'm never one to jump on the bandwagon of cut out your daily coffee, stop taking, takeaway, stop buying your lunches, because for some people that's important. I am going to jump on the bandwagon for now and say, look at things that you don't need. I mean, we all know that we've probably got way too many streaming subscriptions. If I can find you ways of saving $50, $60 a month on refinancing your home loan, $50, $60 a month on cutting out costs that you don't need, $50 or $60 by finding some extra money or some savings on things, you will have saved way more than what these additional interest is going to cost you. So the other thing that I think is really important that you understand is that a lot of people have money just sitting in ordinary savings accounts that aren't actually paying you interest. You may be giving that money to your bank completely interest-free, because a lot of people don't realise that some of those, everyday accounts don't pay any interest. So look at getting money and putting it into an offset account or paying extra into your mortgage, looking at investing that money into a higher interest savings account. And of course, if you're lucky enough that you don't have a mortgage and you don't rent, you potentially could now get a little bit of a rate rise on your investments. But that doesn't mean that you should be lazy. Start looking to see if there's better investments you can get, better term deposits. Is there better high interest investments that you can have? So I want you to be proactive in everything that you do. So let's look at spending, because the thing that I always say is it doesn't matter what your outcome is, whether it's to pay down your debt, whether it's to start building your retirement wealth or start doing some investing, you need to get control of your spending. Now is the perfect opportunity with this rate rise that you can take this opportunity to look where your money spends. Now, if you've been following me long enough, you'll know that I don't love budgets. I do love a spending plan, because that works out where you want to spend your money. And it is the very basis of everything that I do in my course, My Money Makeover. We get you to go through and work out where you spend your money, what shortfalls or things that you can do to change the spending so that you've got additional money to either invest, pay down your debt, put it into your super, start to reach goals that you want to do. So what I want you to do with this rate rise is, as I've said, look at refinancing, all of that, but I want you to sit down and start looking at where you spend your money. The first thing I always say is we obviously want to cut spending on things that are unnecessary. So streaming services, and as I said, I don't want to be one of those people that jump on these bandwagons, but a lot of people that we work with will have nearly every streaming service. There is not enough hours in the day to watch all of them. So maybe get one of them for a month, binge that, whatever it is on that one that you want, cancel that one, get another one. I'm not telling you can't have them all, but don't have them all at once. If you go to the gym, great. Use that gym subscription. Make sure it's there. I always say I had a gym subscription, which I loved it. It was expensive because it was a group class, small numbers, with a personal trainer that walked around and made you do things. And for somebody that hadn't been into the gym for years and years, that was great for me. But it came at a price. And in the last 12 months, I stopped that one. I don't say that where I'm going now is as good because it's relying on me, although I do go with a friend or with somebody that sort of makes me accountable, but it's not quite as good. It is significantly cheaper though. So for me, that was a choice. I wanted to make sure that I could find some money to save. And so I did that, cut the gym and went to one that I just need to be accountable. I need to be disciplined enough to push myself. I'm the first to say it's not as good. The accountability is what I need, but I can't do it. I'm going to go back to the other one in some time, but that's just not for now because, I've got a mortgage rate rise coming through also. The other thing is look at where you can increase your income. So one of the challenges we do inside My Money Makeover is to find $10,000 in the first 12 months of being in my course. Now that sounds a lot when I say it to people, but it is $833 a month. Break that down, it is just over $200 a week. Now, some of the strategies we use in there is stop buying anything that is non-perishable when it's full price. So I always say to everybody, you should never pay for things like dishwashing liquid, washing up detergent, washing powder, hair shampoo, conditioners, moisturizers. Any of those sorts of things should never be bought at full price because they are always on a cycle where they will be discounted. Anything that you can save there, let's say, toilet paper, paper towel, if you can all buy that on sale, you might save yourself $20 a week. I have never bought soft drink if it is not on 40% or more saving because soft drink doesn't go off. Now, we have, Diet Coke, Pepsi Max and all those things in our house. I just buy a carton when it's on sale and I put it in, just in a cupboard and store it. I can guarantee you over the year, I would save close to $3,000 just by never buying non-perishable stuff on sale. So there's $3,000 of my $10,000 straight away. I just went through in our household and we sold a lot of stuff on Marketplace. So we sold off, my husband has a lot of surfboards and he sold off the ones that he doesn't ride anymore. We sold off, I had a gym machine that was in the corner of my garage and hadn't been touched, I would say, in 8 years. So we sold that. I sold off some pots and things, which they were not the fashion that suited my house anymore. We sold off some old desks that we didn't use because the kids now don't go to uni and they had desks in their rooms. What else have we sold? We sold off some cupboards that we didn't use anymore, like long benches and things like that. So finding that $10,000 in a year isn't difficult. You just need to be focused on it. You could always get a hobby that you like and start to do that. You can go on to some of those sites and do some extra work and things. So finding that $10,000 will help you with everything. Now, I get a lot of pushback when I talk to people about finding the $10,000. If you are really focused, the small things you can do, look for savings, look for all of those sorts of things. So putting a spending plan in place, putting your bucket system there is what will get control of your money because we have become a society that taps. And that tapping, unfortunately, is what has led partly to the inflation figures that we want to do. We know from the statistics that we are overspending. We know from the statistics that our credit card debt has increased. We know from the statistics that the buy now, pay later expenses are now increasing and people are paying more and more debt. the payday loans, those cheap ones like the Nimble. You should never have to use those. I want you to start to put in place an emergency fund, or what I call an OMG account, because that's what we say when that unexpected bill comes in. And we'll talk what should have been today's podcast, but it's our podcast next week, about the hit that Adriana got with her new puppy last week. And she has an emergency fund or an OMG account that she could use for that. So you'll hear more about that in next week's podcast. So I think that's it for today. I just wanted to do this podcast to give you some, calming thing, that whilst that rate rise is a shock and a lot of people went into a bit of panic mode yesterday when they heard it, that there's strategies that you can put in place. So that was the RBA's move, as I said, to increase their rate. Your move is what you decide to do. You can sit and do nothing and be impacted by this rate increase, or we can put some of those strategies in place. So look at refinancing, look at where you're spending your money, look at strategies to increase your income, look at your emergency fund so that you don't turn to that short-term debt. Look at what you're doing, take the time to do it, and come into it with a calm, sensible approach. As you know, I'm always here for you with any help that you may need. Just put a comment below or hit reply, and I can help you with anything. Our website, jenrichardson.co, has lots of support help there that you can get, free downloads and things that you can do. Reach out if you need a mortgage broker, or come join me in my money makeover, where we'll go through all those strategies to get control of your debt, find a way to pay down your debt, find ways at spending less, increasing your income, building an investment portfolio, looking at your superannuation, everything that will create financial freedom for you and allow you to live the life that you want to live. So thank you for listening. I hope that something out of today's podcast gave you some help with where you are and what you need to do. As I said, reach out if you need any help. I'm always here for you. Next week, we'll be back with our usual podcast that we're going to be doing, which is a question and answer style from some of our listeners or people in our community. So have a lovely week. Thank you for listening. Reach out if you need me. Come join me in my money makeover. If you need a mortgage broker, let me know. And jump onto our website if you need anything. So have a lovely week. Stay calm. Take affirmative action. Be proactive, not reactive. Our website, of course, is jenrichardson.co. You'll find where you can sign up for My Money Makeover there and be part of the community and the women that we have been helping get control of their finances and their financial future. As I say all the time, money is a tool and you are in control of that tool. And of course, financial knowledge is what will give you financial freedom. Have a lovely week, and I'll see you next Wednesday.